Yogaha Karmasu Kaushalam.
Hello friends, I am Professor Sreniksa. Today in this session, I will discuss the concept of decision making, its process and important terminologies for decision making. Meaning of decision making: decision making is the process of choosing the course of action from amongst the available alternative courses of action. Every manager, regardless of the level in which he operates, is a decision maker. Decision making is not a separate function of management, but yet it pervades every one of the managerial functions of planning, organizing, staffing, coordinating and controlling. It is precisely because of this reason that according to Peter Drucker, whatever a manager does, he does through making decisions. Decision making involves the problem of choice. So long as the available economic resources are scarce in relation to demand, this problem should be faced by every one of us. It is so whether we are consumers or producers or managerial personnel. If alternatives are not available, there would not be any problem of choice, hence nothing like decision making. Managerial function of decision making. Modern business units are dynamic entities. They have to function in world of uncertainty. The environment in which a business entity functions is such that management of such an entity seldom has full information about the factors having a bearing on its profits. If knowledge regarding future sales, cost, profits and prices were perfect, the task of decision making would be greatly facilitated. The choice of a particular course of action would never be a problem. It is precisely for these reasons that decision making has become more complicated than what was in the past. In olden days, when business units were small, the man at the top took upon himself the responsibility of performing every one of the business functions. He himself gathered the required information or facts on which his decisions were based. He made decisions pertaining to his business all by himself. In the case of a business as it functions today, the situation is quite different. Hence, the importance of decision making is increased. Decision theory. Decision theory is defined as a body of knowledge that allows the evaluation of different courses of actions can be measured. Decision theory is thus a new branch of knowledge for purpose of problem solving or decision making. Although a new branch, it falls into the domain of statistics and is made use of with other management techniques and in the various situations. Decision theory is concerned with the real world situations. It is characterized by data which is uncertain and incomplete. It evaluates different alternative courses of action where these alternatives are capable of being measured in terms of monetary outcome. This theory permits examinations of all the available alternatives to enable managers to make a decision with the knowledge of monetary consequences of each alternative action. Now, let us come to types of decision. Managerial decisions are of two types. They are number 1, strategic decisions and known as long term decisions involving huge capital investment in anticipation of cash flows over several years. Number 2, tactical decisions and known as operating decisions extends over a period of 1 year. They are routine in nature. In spite of this distinction between the two types of decisions, it may be mentioned that this distinction is not watertight. Strictly speaking, it is not possible to classify the various decisions into these two types. Whether a decision is going to be strategic or tactical depends upon the problem, the amount of investment involved and the duration of investment. Some problems may, however, be either strategic or tactical in different situations. Now, let us come to information for decision making. The cost management system has to support management decision making with quality information. The dimensions of quality are decision usefulness, objectivity, accuracy, timeliness, cost and relevance for the decision at hand. Decision usefulness of information is whether managers make sufficiently better decisions to justify the cost of the information. Objectivity is the degree of consensus about what to measure, how to measure, or whether the measurement is important. In a decision making process, subjectivity, which stands for the degree of disagreement about what to measure, how to measure etc., should be reduced. Information pertinent to the decision at the hand must also be accurate. Accuracy is therefore precision in measurement. Timeliness means that information is available in time to fully consider it in making a decision. Cost of providing or gathering the information must justify the benefits. Lastly, relevance refers to pertinence in a decision context. If the information is not pertinent to the decision at hand, it is not relevant. In a decision situation, both quantitative and qualitative factors are considered among the competing alternatives, and the alternative that is expected to give optimum results is selected. Qualitative factors are outcomes that cannot be measured in numerical terms, as for example, employee morale, relationship with suppliers, etc. These factors should be given equal importance along with the quantitative factors. Quantitative factors again may be financial and non-financial. Financial quantitative information are relevant cost and relevant revenues. All cost and all revenues are not relevant for all decisions. Some cost and revenues are relevant while others are not. Decision making process. The process of decision making involves a problem and its diagnosis. The need for decision making arises only when a problem crops up. A problem is defined as a gap between the existing or forecast condition and the desired condition. A problem may arise either because of an external event or an event purely internal to the business. The introduction of a new product by a competitor is an external event. However, the need to replace the existing machine is internal event. B. Goal or objectives. Since the solution of a problem is subject to a number of limitations, it is necessary to know what the limitations are in the backdrop of goals or objectives of business. For instance, profit may be the goal affecting a particular decision. Since profit is also the ultimate goal of survival, the same is too remote to be considered. Hence, it becomes necessary to take into consideration the immediate and more fundamental objectives that should guide the decision maker. C. Analysis. The next step in decision making is to analyze and classify pertinent facts. Although it is not always possible to collect all the facts that are necessary for the decision, the manager has to collect and classify only pertinent facts having a bearing upon the problem and affecting the decision. D. Alternative solutions. Hardly is there a problem in modern times for which alternative solutions are not found. In many cases, alternatives may not be obvious, but yet they can be sought out. Even if many alternatives are not available, the decision maker has to make a search for at least one alternative that provides a satisfactory solution to the problem. E. Best solution. After having searched alternative courses of action, the manager has to test each of them in the light of its merits and drawbacks. While doing so, he has to find out the desirable and undesirable consequences of adopting each alternative. Having done so, he has to adopt the course of action which he thinks best under the prevailing circumstances. Now, we come to the techniques for decision making. Some of the techniques used for decision making are 1. Marginal costing, 2. Break-even analysis, and 3. Differential cost analysis. Now, we switch to the terminologies for cost for decision making. 1. Marginal cost, 2. Relevant cost, 3. Differential cost, 4. Sunk cost, 5. Opportunity cost, 6. Imputed cost, 7. Replacement cost, 8. Out of pocket cost, 9. Conversion cost. Now, let us come to the each term individually. So, first marginal cost. Marginal cost is that which includes only variable cost and does not include fixed cost. At any given level of output, when a unit of product is added or reduced, the difference in the total cost is marginal cost. Thus, marginal costing is very useful for decision making. In fact, it is a major tool for decision making. Now, number 2, relevant cost. Relevant cost is any cost which is affected by a decision. While taking decision about selecting an alternative from 3 or 4 alternatives, there are certain costs which must be taken into consideration which are relevant cost. There are certain costs which are not necessary to be taken into consideration while selecting an alternative, and they are irrelevant cost. As for example, if a company closes down a branch, then staff salaries, wages, electricity, telephone charges, etc. are not to be paid. So, they are relevant cost for taking a decision to close down a branch. But if a building has been taken on lease for the branch and lease rent has been paid in advance, then lease rent is irrelevant cost for taking a decision, because closing down or not closing down the branch has no effect on the amount of lease rent. It is already paid. Thus, relevant cost is a cost, but for which the decision would be different. Relevant costs are those expected future costs which are essential, but are different for different alternative courses of action. They draw the attention of managers to those elements of cost which they must take into account to arrive at a decision. A relevant cost or future cost. The decision is to be implemented in future, and so relevant costs are also to be incurred in future. Of course, all future costs are not relevant cost, but all relevant costs are future cost. Those costs which have already been incurred in the past cannot have any effect on the decision about the transaction to be incurred in future. Similarly, any expenses which is to be paid in future in connection with any legal agreement made in the past is also not a relevant cost, because it is not going to be affected by selecting either this or that alternative. B. Relevant costs are different for different alternatives. When 2 or more alternatives are considered, the relevant cost would be different from, in fact, one alternative is profitable because relevant cost for that alternative is the least. As for example, if a decision for replacing manual labor by a machine is to be taken, then per unit material cost is irrelevant because it is not going to change, while labor costs are relevant because they would be different for 2 different alternatives. If the labor cost per unit in manual alternative is rupees 5 and for machine alternative is rupees 2 per unit, here the relevant costs are different and machine alternative is selected because relevant cost is the least. C. All relevant costs are not available from books. Details of all relevant costs are not available from the books or records, as only those expenses are recorded in books which are already paid. Other expenses are to be estimated. Now, we come to the third cost, that is differential cost. As a decision making technique, differential cost analysis shows how cost and revenue would be different for an alternative course of action when a choice to be made between 2 courses of action. Although cost concepts do not include differential cost, there is nothing like differential cost which could just be picked up from accounting records and analyzed. It is only when cost differences of alternatives are considered we use the term differential costs. The official CIMA terminology defines the term differential cost as the difference in total cost between 2 alternatives calculated to assist decision making. The term thus indicates the difference in cost between alternatives. The emphasis is on change in total cost, both the variable and fixed, associated with the alternatives. In other words, differential cost analysis, cost and revenues are estimated for the alternative course of action. A comparison is also made between the 2 alternative courses for finding out how cost and revenue would be different for different courses. It is only subsequently that decision is made regarding the choice of course of action. According to Harper, differential costing is a decision making technique in which only cost and income difference between alternatives are examined. When laid out correctly, these differences indicate the profitability differences between alternatives so that most profitable alternatives can be identified. Thus, differential cost is a difference in total cost between alternatives. Differential costing, on the other hand, is a technique of decision making by taking into consideration cost and income. Difference between alternative courses of action. Features of differential costing. 1. Differential costs do not find a place in the accounting records, though they may be incorporated in budgets. 2. The data may be used for analysis of cost, revenue and the investment factors that will be affected by the decision towards which the analysis is directed. 3. Differential costs are estimated by studying the total of the elements of differential cost rather than cost per unit. 4. Items of cost which are identical for the alternatives are left out since they are irrelevant. Only the difference in cost at two levels of activities or alternative courses of action are considered relevant. 5. The differentials are measured from a common base position such as the present level of output. 6. The analysis is limited to real difference in cost and not merely apparent difference that result from methods of accounting for the costs incurred. 7. Differential cost analysis emphasizes future cost. However, historical or standard cost, although relevant, may be used in the projection of future cost. However, necessary adjustments to the requirements of future conditions should be made to the same. Incremental cost analysis. The official CIMA terminology does not distinguish between differential and incremental costs. It considers the two concepts as synonyms. This is obviously because of the reason that differential cost means cost difference between alternatives. This cost difference may be an increased cost or decrease in it. If the cost difference is an increase, it may be called incremental cost. Similarly, if the cost difference is decrease, the same may be called decremental cost. Accordingly, incremental cost and decremental cost are nothing other than differential costs. This is the broad conception of differential cost. Now, we switch to similarity between differential and marginal costing. A. Both differential costing and marginal costing are the techniques of cost analysis and presentation of cost data to management. B. Information supplied by both the techniques is used by management for planning and decision making. C. Differential cost analysis, like that of marginal cost analysis, is based upon the behavior of cost under varying conditions. D. Both the techniques will be the same if there is no change in fixed cost in an alternative course of action. Now, we come to the differences between differential costing and marginal costing. A. The scope of differential costing is much wider than that of marginal costing. B. Marginal costing is confined to short run tactical decisions, although differential costing is the technique of long run decisions making. It becomes relevant and appropriate for both short run and long run decisions where fixed costs change. C. Marginal cost can precisely be defined as prime cost plus variable overheads. However, differential cost cannot be precisely defined except in terms of increase or decrease in total cost. D. Under the marginal costing technique, cost information is presented to managerial personnel by the contribution approach. However, differential costs are presented under both absorption and marginal costing techniques. E. Contribution and profit volume ratio are the criteria of performance evaluation and decision making in the case of marginal costing. However, a comparison of differential cost with incremental revenue is a basis of policy decisions under the differential cost analysis. F. Differential cost do not find a place in the accounting records. This is because of the fact that they are anticipated cost and refer to future operations. They may, however, be incorporated in budgets. Marginal costs, however, may be incorporated in the accounting system. Now, we switch to the fourth term, that is sunk cost. A sunk cost is an expenditure made in the past that cannot be changed and over which management no longer has control. These costs are not relevant for decision making about the future. Thus, the book value of an asset currently being used is not relevant in making the decision to replace it. Similarly, the cost of land purchase in 1980 is not relevant in deciding whether to sell the land or hold it. What is relevant is how much cash could be realized in future by selling it. Despite the fact that sunk costs, which are historical costs, are irrelevant for making decisions, they are frequently analyzed in detail before decisions about future courses of action are made. For example, historical costs may affect future tax payments, which will differ depending on the course of action selected by management. Moreover, an analysis of historical cost may provide information about how future cost will differ under alternative courses of action. One should understand the difference between sunk cost and irrelevant cost. Not all irrelevant costs are sunk cost, but all sunk costs are irrelevant. To take an example, in choosing from the two alternative methods of production, if direct material cost is same under the two alternatives, it is an irrelevant cost. But direct material cost is not a sunk cost because it will be incurred in future and is a future cost. In the opinion of Holmgren, a well known authority on the subject, sunk cost has the same meaning as the past cost and all past costs are irrelevant. Now, number 5, opportunity cost. Opportunity cost is a sacrifice involved in accepting an alternative under consideration. In other words, it is a cost that measures the benefit that is lost or sacrificed when the choice of one course of action requires that other alternative course of action be given up. For example, a company has deposited rupees 1 lakh in bank at 10% interest per annum. Now, it is considering a proposal to invest this amount in debentures where the yield is 17% per annum. If the company decides to invest in debentures, it will have to forego bank interest of rupees 10,000 per annum, which is the opportunity cost. Opportunity cost is a pure decision making cost. It is an imputed cost that does not require cash outlay and it is not entered in the accounting books. Now, the 6th term, imputed cost. These are hypothetical costs which are specially computed outside the accounting system for the purpose of decision making. Interest on capital is a common type of imputed cost. As interest on capital is usually not included in cost, it is considered necessary to take into account when deciding about the alternative capital investment projects. The failure to consider imputed interest cost may result in erroneous decisions. For example, project A requires a capital investment of rupees 5 lakhs and project B rupees 4 lakhs. Both the projects are expected to yield rupees 1 lakh as additional profit. Obviously, these two projects are not equally profitable since project B requires less investment and thus it should be preferred. Similarly, rental value of building owned by a firm is also an imputed cost. Now, 7th term, replacement cost. This is the cost at which there could be purchased an asset identical to that which is being replaced. In simple words, replacement cost is the current market cost of replacing an asset. When the management considers the replacement of an asset, it has to keep in mind its replacement cost and not the cost at which it was purchased earlier. For example, the machinery purchased in 1990 at rupees 10 lakhs is discarded in 1998 and a new machinery of same type is purchased for rupees 15 lakhs. So, the replacement cost of the machinery is 15 lakhs. Number 8, out of pocket cost. There are certain costs which requires cash payments to be made such as wages, rent, etc., whereas many costs do not require cash outlay such as depreciation. Out of pocket costs are those costs that involve cash outlays or require the utilization of current resources. Examples of out of pocket costs are wages, material cost, insurance, cartages, etc. Out of pocket cost may be either fixed manager's salary or variable raw materials and direct wages. Depreciation on plant and machinery does not involve any cash outlay and therefore is not an out of pocket cost. Out of pocket cost is frequently used as an aid to make or buy decisions and price fixation during various situations. Number 9, conversion cost. This term is used to denote the sum of direct labor and factory overhead cost in the production of a product. It is the total cost of converting a raw material into a finished product. Appropriate use of this cost can be made in certain managerial decisions. Direct material plus direct labor is equal to prime cost. It should be noted that labor cost is a part of prime cost as well as conversion cost. So, direct labor plus factory overheads is conversion cost. Now, let us come to illustration 1. A company is considering a contract which will require among other inputs 50 kilograms of material M. 80 kilograms of material M are in stock which were purchased for rupees 1.60 per kilogram. The replacement price of M is rupees 1.75 per kg. The material is in stock as a result of buying error and the company has no other use for it. If not used on this contract, it would be sold for rupees 1.20 per kg. What is the relevant cost of the material to be used in this contract? Now, let us come to the solution of illustration 1. The relevant cost of raw material M for this contract is 50 kilogram into 1.20, that is selling price, is equal to rupees 60. The following costs are not relevant. The purchase cost of 80 kilogram at rupees 1.60 per kilogram is a sunk cost, because the amount is not going to be recovered whether this order is accepted or not. Replacement cost of rupees 1.75 per kilogram of material M is also irrelevant, because it has no other use of it in the company and should not be replaced. Now, let us come to illustration 2. X Limited, having an installed capacity of 1 lakh units of a product, is currently operating at 70% utilization. At current level of input prices, unit cost work out as follows: capacity utilization percentage, unit cost at 70% 97 per unit, at 80% 92 per unit, at 90% 87 per unit, at 100% capacity utilization 82 per unit. Calculate differential cost at various capacity utilization. Now, let us come to the solution. We will have the columns for the statement of differential cost as: first column capacity utilization, second column production, that is in units, third column cost, fourth column total cost, fifth column increase in production units, next column differential cost, and the last column differential cost per unit. At capacity utilization 70%, production is 70,000 units, cost is 97 per unit, total cost 67,90,000. At 80% capacity utilization, production is 80,000, cost per unit is 92, 73,60,000 is total cost. So, increase in production 10,000, differential cost is 5,70,000. So, per unit it comes to 57. Similarly, at 90% capacity utilization, production 90,000, cost per unit 87. So, total cost 78,30,000, increase in production 10,000 compared to the previous level, and increase in cost is 4,70,000. So, differential cost per unit comes to 47. At 100% capacity utilization, production in units are 1 lakh, cost per unit 82, total cost 82 lakhs, and difference in the production is 10,000 and differential cost is 3,70,000. So, differential cost per unit is 37. Now, summary. In this module, we learned the concept of decision making, decision theory, important decision areas and types of decision and important terminologies of cost for decision making process. Thank you.